Update. Let's move on to the promised conversation on cement. It's time for our special segment, Quarter Se Quarter Tak. We have Nigel on the wall to first tell us what all has happened with the sector in the third quarter and what the broad expectations are. Nigel.
Well, that's right. For the cement industry, quarter three is likely to see some signs of improvement for the cement companies, with volumes, prices, as well as profitability probably bottoming out. Now, industry volume growth is expected to be in mid-single digits, which is better than the flattish number that we saw in the first half of the fiscal. The reasons for improvement include a pickup in the run rate of government capex, recovery in construction demand post the monsoon, as well as the festive-related slowdown. Now, large cap names like UltraTech as well as Dalmia, they're expected to report high single-digit volume growth. ACC as well as Ambuja, they'll report mid-teens volume growth due to the acquisition of Sanghi Industries as well as Penna, and also due to the master supply agreement between the two. Shree Cement will relatively underperform. The volumes out there will see a bit of a degrowth. And among smaller names, surprise, surprise, Nuvoco is expected to outperform. They'll deliver mid-teens volume growth, but that comes on a very, very low base. Moving to pricing, cement prices finally witnessed a recovery in quarter three after 3 weak quarters. They've gradually moved up from those 4-year lows that were witnessed in the past quarter. Now, price hike attempts appear to be finally going through in most regions. That's barring South India, which is expected to see a dip in prices even in quarter three. Now, the street estimates that close to around 1.5 to 2% improvement in realizations, though it will be much lower on a year-on-year basis. Prices could be lower by around 8 to around 10%. North India, that's the one that's likely to lead the improvement, while West is also likely to see some kind of improvement. Now, both pricing as well as volumes will improve. So that's what points to an improvement in the overall profitability on a sequential basis for most of the companies. And that will arrest that decline that we were seeing in the profitability in the past few quarters. There is also an anticipation that profitability will further improve from year on. That's from quarter three and then quarter four onwards. Industry estimates suggest that the average EBITDA per ton could improve by roughly around 170 rupees sequentially, though it will be lower by roughly around 300 rupees per ton on a year-on-year basis. Now, coupled with the improvement in pricing, the aggregate cost per ton should come down by around 2 to around 3%. That's because petcoke, international coal prices, both of them are expected to remain soft, which will result in fuel cost savings. Jefferies, they have come out of the north. They're mentioning some relative out and underperformers. The potential outperformers, well, they include UltraTech that could report relatively lower EBITDA on a year-on-year basis, but on a sequential basis, there'll be some improvement. Dalmia, Shree, JK Cement as well as Ramco, they'll take a sharper knock as well on a year-on-year basis. On a sequential basis, things could look better. JK Cement could report the highest increase on a unit EBITDA per ton, while Ramco, that could be a relative underperformer because the EBITDA improvement sequential will be marginal, and on a year-on-year basis, it will be much lower. Let's wind it down with the valuation snapshot. The large names like UltraTech, Ambuja, as well as Shree, they enjoy higher multiples, while underperformers like Dalmia, Nuvoco, as well as ACC, they trade at sub 10 times EV on EBITDA. The hope is quarter three shows some kind of green shoots, which will further improve in quarter four, which is incidentally a seasonally strong quarter. Well, let's welcome Rajesh Ravi, who joins us on the show. Hi, Rajesh. Good morning. Good to see you in. What's your take? Quarter three will be the bottoming out quarter and things improve from here on. Fill us in with a couple of numbers. Aggregate EBITDA per ton, how much does it improve in quarter three? And for quarter four, how much more better can it get?
Hi, good morning, Nigel, and thanks for having me on the show. Yes, you covered it nicely in terms of the expectations for Q3. So volume, which was sluggish in H1, is finally expected to recover around 5% in Q3 year-on-year. But mind you, this is suboptimal given that the expectations were that the volume should in H2 look up north, would be close to 8 to 10%, and that is where even the top managements were guiding that demand should pick up. That Q3 hasn't materialized, and that is why even the pricing action has been suboptimal. Less around 1 to 2% in most markets. South market prices have again slipped in Q3. So last major pricing action we had seen was in September of 2023. After that, prices have been on a slippery slope only. All efforts have been, none of them materialized. Q3, finally, we have seen some improvement in realization, and there are hope that in Q4, with demand accelerating, most of the pent-up demand, getting executed in Q4, the pricing action should be better than what we have seen in Q3. So overall, there is hope with good amount of probability that Q3 margins have bottomed out, and sequentially, as you pointed out, the expectation is close to 170 to 180 rupees margin improvement. In Q3, we should see at least similar 150 to 200 odd rupees margin improvement at least in Q4, premising that 100 odd plus should come in through realization and 100 odd through coming through operating leverage and some of the cost savings. So at least 200 rupees margin improvement in Q4 should be there, and then the margin profile year on year may look better versus Q3 when we are sharply down year on year.
Got it. All right, Rajesh, give us a few more details then in terms of preference of stocks. ACC and Ambuja Cements,
Yeah.
There's a group level inquiry that comes about, and then the markets get a little bit jittery. How do you approach both these two names? Because valuation wise, relatively, and also in comparison to replacement cost for ACC, they have come down to attractive levels. You agree?
So, to look at ACC independently as a cheap stock, maybe something which could be looked upon differently. Yes, it is very cheap. In our view, it is trading at $90, which is for a 30 million ton plus company. But how and when, at what ratio the merger would happen in Ambuja, whenever that happens, that is what puts keep the valuation under check, because recently you saw how Sanghi acquisition, while the promoter stake initial was purchased at north of 100 rupees per share, the share swap ratio which came in recently is close to at 62 rupees. So ACC per se, the valuation is for sure not to be looked at independently. Ambuja, on a console basis, in our view, it is trading close to $160, which we believe is a comfortable zone when we look at Ultratech, which is trading north of $200. And we believe that Ultratech and Ambuja today, on a console level, both the companies will have similar margin profile, and volume growth in Ambuja in near term will outpace Ultratech because of the in acquisitions volume getting accumulated in the growth numbers. So from that perspective, Ambuja's valuation is comfortable versus Ultratech.
Okay, all right. Just hold on to that thought, Rajesh. We have some source-based information that's coming in there. IDBI Bank is seeing a bit of a spike up because the March FY25 target is intact for receiving financial bids for IDBI Bank, and that's why that stock has moved to the high point of the day. Big volume spike is what we're seeing on that one. Rajesh, I wanted to ask you a couple of other questions then. Stocks like Nuvoco, they came out with an IPO at the peak. Everything looked so good, and then everything went away. At around this 350 mark, people are talking about it getting acquired. Now, valuation-wise, it's in their favor. It'll be interesting to see how they can turn around this asset. But what's your take on stocks like Nuvoco? Dalmia is down more than 25% from the peak, particularly on both these two names.
Correct. So coming to Dalmia first, see, this is becoming a 50 million ton franchise by end of this year, and this company, the balance sheet is quite comfortable. The company has faced challenges in terms of volume growth. FY24 second half and FY25 also, they have struggled for volume growth in the first half. Q3 at least they are trying to recover on that. They have recently got a marketing head on board also. So the management is taking corrective steps, and I believe if your balance sheet is healthy and your focus is in terms of cost efficiencies, where Dalmia is already efficient enough, and they are also improving their green power mix, we believe it's just a matter of time when with the volume growth comfort coming in, the valuation should again prop up. It should easily get $130, $140 valuation. So Dalmia is for sure, whenever the pricing improvement happens across the industry, and in the interim, the volume growth efforts start playing out, I believe the stock is up for a re-rating. Coming to Nuvoco, yes, when it came for the IPO, the market was a different zone. All building material stocks, demand was super strong. East market was growing in high double digit, and thereafter we faced both demand challenges, and the coal prices also went for a toss, impacting everyone. And Nuvoco had a high leveraged balance sheet. However, the management did the right thing in scaling down incremental capex, and now this Badraj acquisition, which they have done at $60 versus the current trading at $70, we believe this is not very front-ended in terms of capex expenditure. Most of this will happen between FY26, 27, and partly may flow into FY28 also. And they have put down, they have shelved their north expansion plans, brownfield, which they were planning. So net, this should not lead to any major stretch. Yes, the key would be they're ramping up the assets, which they believe. What the management has said that they have got it evaluated from multiple vendors, independent vendors, and they are confident that the plant can be up and running at a total cost of $60 per ton. If that happens, the strategic nature for them is that they could service the Gujarat market, and they could also look going into Maharashtra and some other potential south market as Sanghi was planning, and hence their north capacity will be freed up, and they could be delivering growth across the from east market, north, and Gujarat markets, west markets.
Okay. All right. Very quickly, Rajesh, before we let you go, as of today, how much have prices improved in comparison to an average for Q3?
So prices in so far, see, this is the first few days. The prices have not improved much because this is still the non-auspicious period. Only the projects which are undergoing continuously just is what is being executed. So most of the pricing action are now expected to play out between January and February, and we believe if any major effort in terms of the pricing, that should be visible by month of February, and only then we could say that the pricing action is strong enough to sustain the earnings estimate which we are penning in for FY26.
Okay, so no big improvement in pricing. Thanks a lot, Rajesh, for joining in and helping us out with your quick analysis. So the optimism is that Q3 sees some kind of improvement, and Q4, which is normally the seasonally strong quarter, we see a further improvement from year on. And Ambuja's valuation, as he said, looks relatively more favorable in comparison to Ultratech. Mitesh Thakkar is back.